What fascinates me about the investment industry and the financial markets is that financial people in general, the economists who work for Wall Street firms and so forth, with very few exceptions, they rely on statistics that are published by the government. Now, I have sources that would indicate that inflation, and this is not just one source and one kind of mysterious economist in the background, but numerous sources indicate that inflation over the last 30, 40 years has been much higher than what the government is saying it has been. And so if you take nominal GDP figures and you say the GDP grew at 3% or 2.5% and inflation was 3 or 4% instead of what the government is calculating at 1.5 or 2%, then suddenly in real terms GDP is down. And I can tell you that the majority of Americans, say the median household in America, is struggling. We have this from all sorts of companies that sell retail goods to people and services, that consumers are not as strong as they used to be. They're struggling even to pay their grocery bills. Over 70% of US households depend on paycheck to pay their bills. If someone tells me the economy is strong, then he believes in nonsense. The economy is not strong, and GDP is a meaningless figure. What matters is the standard of living of people. Are they better off than 10 years ago, or are they worse off? And I can tell you, in the whole of Europe and the United States, the typical household is not as well off and earns less than his parents used to earn in real terms, inflation adjusted. In Canada and the US, in some areas, homes have gone up more than the rate of consumer price inflation. But I want to make one thing very clear. The Fed and American economists look at inflation as an increase in the cost of living, say grocery bills and consumer goods and services and so forth. But I look at inflation also at the increase in the value of assets. So I distinguish between consumer good inflation and asset inflation. When consumer goods go up, all the housewives, they complain. When the prices of homes and stocks and bonds and collectibles and baseball cards, like the recent one, like the memorabilia of Babe Ruth was sold recently, a t-shirt for 23 or 26 million. That is also inflation. But the Fed closes its eyes because it's an inconvenient inflation which is not obviously visible. So that they don't count in. But the true inflation is actually an increase in the quantity of money and credit. That is inflation. And then you have all the symptoms. Commodities go up. Stocks go up. Last year, the price of cocoa went up. This year, the price of coffee is up 37%. But then they make adjustments to the weighting of things. In the CPI, the Fed calculates that in the last few years, healthcare costs have come down. What a joke. Everybody can see that the cost of healthcare is up meaningfully. Everybody can see that, except the academics at the Federal Reserve. That upsets me. And what upsets me is that Wall Street economists, they just rubber stamp what the Fed is saying and doing. Because, of course, the financial sector, I love inflation because my assets go up in price. But as a social observer and as an economist and as a historian, I can tell you the consequences of high inflation on a society are disastrous. And inflation is a tax. Nobody should make the mistake to think that it's anything else. It's a tax, but it's an unfair tax on the lower classes of society. That's why the rich love inflation like me. That the tax touches other people. A bank recently made a survey, and the clients of the banks are investors. They expect, listen to this, returns of 15% per annum, inflation adjusted over the next 10 years. 15% per annum. The Dow Jones over the last 100 years has returned something like, 5% per annum, inflation adjusted. The expectations of investors, especially young investors, is completely unrealistic. I think people should sit down and consider the possibility based on the following. We had for the last 40 years, since 1981 for bonds and stocks, since August 82 when the Dow Jones was below 800, we had a huge bull market in stocks and in bonds and in real estate and in everything. This asset inflation, which is especially pronounced in, say, art prices and in collectibles and also in cryptocurrencies and so forth, this whole asset bubble may deflate. That is a possibility that investors should entertain. And if it deflates, the thinking should be, everything drops 50%. How do I only drop 20%? Because if everybody loses 50% and you only lose 20%, you're like the king because you lose less than the others. So in real terms, your wealth increases. And to do that, in my opinion, you have to be light on equities, on stocks. I think financial assets are the most vulnerable. Because if you look at the financial market in the, say, 50s, 60s, 70s, the real economy is this big, and the financial market is tiny, like this finger. In other words, the real economy was much larger than the financial market. But now, the financial market is a huge bubble like this, and the real economy is just like this. And this bubble in assets, in my view, sooner or later will be deflated. In my view, if Kamala Harris is elected, it will be deflated very badly. But it may not be deflated in nominal terms. You understand? If you print enough money, you can keep the illusion up there. But the reality is that in real terms, inflation adjusted, your wealth will shrink. I give you an example. The Dow Jones hit almost 1,000 in 1964, and then it hit more than 1,000 in 1973 and in 68. But in 1982, it was no higher than in 64. In other words, it was at the same level in nominal terms. But inflation adjusted, it was down 70%, 70%. I'm embarrassed to say the economy is not in recession for me, because compared to the last few years, now on my deposits, I get 5% return. And before I got less than 1%. So for the rich people like me, the economy is not in recession. But for the lower income recipients, say you can structure your society in the 20% lowest income recipients, 40% lowest, 60. For the 60% of Americans, their wages and their income inflation adjusted, and inflation adjusted by people like John Williams, who actually calculate how much a household spends on this and that and so forth, or Kopok index. In these terms, 60% of Americans are less well off than their parents were 30, 40 years ago. And the last few years have been disastrous. The Fed will tell you, we've beaten inflation. Nonsense! The cost of living today is approximately 30% higher than in 2018. That hasn't come down. I agree that right now prices are going up at a lower rate than before. But the prices haven't come down. The home prices are still high. Talked about home prices. The result of high home prices is that most Americans can't afford to buy them. That is the problem. They can't even afford to buy the groceries. I don't want to destroy the illusions of the Americans about their income, but Irving Fisher, who I regard as one of the most important economists, he wrote about the monetary illusion, the money illusion. It's very important to understand when you print money for a while, people feel wealthier, and there is a boom during the process of money printing, but very shortly it changes the viciousness of inflation. you can have for a while home prices and stocks going up, and then suddenly consumer prices go up, and suddenly commodities go up. It's not that the price level goes up evenly in a society. No, it goes up here and then there and so forth. So members of society get hurt at different times. But the Fed, one quality they have, they will always protect their friends on Wall Street. That you can bet upon. What the single worker does in the factory in Middle America, they don't give a shit about. That you can be sure. For the real economy, for the people who work every day, they are farmers, they are working grocery stores, they are people that borrowed money to buy a home, they have children, they pay fees to send the children to schools or to kindergarten and so forth and so on. For these people, interest rates should be cut. But I've never seen a central bank cutting interest rates when the stock market is near an all-time high, when Bitcoins was moving up strongly, when gold was making new highs, and when there was still a huge quantity of liquidity in the system. There's no liquidity crisis at the present time. I wrote now 3 reports about turning points in asset markets. Whatever happens, I think we are at a very important juncture where stocks of the popular sectors, semiconductors, the FANG stocks, the Magnificent Seven and so forth, they are going to sleep for the next few years, and they will sleep very deeply, in other words, by going down. And other stocks, value stocks, will tend to go up. And other markets around the world, notably emerging economies, will start to move up in their performance. Because this is for the history books, financial history books. Bank credit analysts, and I followed their services for the last 50 years. It's a very interesting, organization like Alpine Macro. They do macro work. They published a chart showing the market capitalization of the Magnificent Seven stocks and the market cap of all Chinese stocks, including Hong Kong. The Magnificent Seven have a higher market value than the market of a country with more than 1 billion people and some very successful companies. That's why the American State Department is always embargoing these companies.